Welcome back to the Capital Stewards Podcast. If you're worried about having too much exposure to high-flying assets like US artificial intelligence tech stocks or gold, then this episode is for you. If you think bonds are boring, this episode is also for you. If you look at your brokerage statement and you think, I own a lot of different things, I'm diversified, I should be okay, then this episode is for you. From 2010 through the COVID period, investing was, I kind of liken it to riding an escalator. You just had to step on to the S&P 500 index and you just went up a little bit every year. But now the escalator ride has kind of changed. We have to think about building diversified portfolios. The myth about diversification is that holding hundreds of assets in your portfolio means that you're automatically diversified. The reality is that even though you own a bunch of different assets, they can still move down at exactly the same time, leaving you less diversified and with a lot less money than you thought if something happens. So in this episode, I'm going to talk about what real diversification looks like and how to build a portfolio that can provide both investment returns and resilience over time. Let's start with the hard truth. Most people aren't diversified. They're just collectors. I see portfolios that look like collections all the time. An S&P 500 fund, a NASDAQ fund, maybe the QQQ. And then there's a mutual fund that picks the best technology stocks. And then there's a few shares of Apple and Microsoft. On paper, that's 5 different investments, but in reality, it's one bet. It's a bet on large cap US growth, particularly on the AI theme that we've seen in the last couple of years in the market. If interest rates spike or if the AI bubble burst, then every single one of those assets is going to get hit. Think of it like this. If you own a sunscreen company and an ice cream shop and a sunglass hut, you're diversified. You've got 3 different things. But if it rains, you go broke. You're weather dependent, right? So true diversification means that you own an umbrella shop and the sunscreen and the ice cream and all the other things that are about having a fun beach day. You got to have all of that stuff together at the same time. So we want to distinguish when we talk about diversification between company-specific risk and systematic risk. Company-specific risk is the risk that a specific company fails. You can diversify that company-specific risk away by owning 20 or 30 stocks. There's a lot of research on that, well-founded, well-established. It's pretty unlikely that an S&P 500 company is going to truly fail to file bankruptcy. It happens, certainly. But if you own 20 or 30 different stocks, you're going to diversify away the risk that one of those events creates an issue. Your portfolio probably didn't take a dramatic hit when PG&E caused a wildfire in California in 2019 or in March of 2023 when a few smaller banks failed. And that's because you had a variety of different stocks. But your portfolio did probably suffer in the COVID pandemic in 2020, and then again in 2022 when interest rates increased quickly. So this is the definition of systematic risk, right? It's the risk that the whole market crashes. You can't diversify that away by buying more stocks in the same categories. If we have trouble tied to the AI theme in the US, most companies are going to suffer. If interest rates move up dramatically higher again, most companies, especially US tech and AI, those stories are going to suffer. You may have heard about market concentration in the US being at all-time highs, and that's true. The top 8 companies in the S&P 500 are NVIDIA, Apple, Microsoft, Amazon, Google, Facebook, Broadcom, and Tesla. That's 38% of the index, and their earnings projections are all in some way based around the future growth story of artificial intelligence. And I'm bullish on AI, by the way. This is going to sound like I think something bad's going to happen to AI. I think AI is probably going to lead a wave of activity across the economy, but that doesn't mean that I have on rose-colored glasses. If something unexpected happens to the AI story in the US, then the S&P 500 is going to have a problem. And you need to buy something in your portfolio that produces returns that's not tied to the same thing. Now, diversification hasn't been that big of a deal over the last, we'll call it 10 or 15 years, right? Let's talk about why diversification, I think, matters more now than it did when we were in that period of sort of the escalator ever going upward. From 2010 to 2020, we lived in a very unique environment. Interest rates were zero. When rates are zero, money's free. That pushed the price of everything up. So real estate, stocks, bonds, cryptocurrency, vintage cars, art, didn't matter. All of it went up. And so if you owned assets, your portfolio was increasing in value. More importantly, during the 2010s, that decade, stocks and bonds were best friends because they moved in opposite directions. Stocks crashed out a little bit. The Fed cut rates. Bonds went up. Your portfolio was saved. But in the post-2020 world, inflation is stickier. Interest rates are higher, currently sitting much higher than they were over the last decade. And so in a high inflation environment, stocks and bonds can fall at the same time. We saw that in 2022, and those correlations have stayed actually pretty high over the last couple of years. Why is that? Aren't stocks and bonds supposed to move in opposite directions? The reason for that is called duration. And duration is just a fancy finance word for the sensitivity of an asset to interest rates. Investments that produce all their cash flows and their returns over the next few years have short durations. Changing interest rates doesn't really impact the value of those cash flows very much. Inflation isn't going to impact, the values of those assets that much. If you promise to give me $100 a year from now or 6 months from now, it's probably going to buy just about the same amount of stuff that $100 today would. But when you push those cash flows out 10 years, now inflation and higher interest rates take a bigger bite out of those cash flows. That $100 is going to buy me a lot less stuff in 10 years than it buys me today. So if you think about stocks and bonds in the same context, a 30-year treasury bond has a really long duration. You don't get your money back for a long time. A high-flying tech company that's counting on future profits from AI in 2035 also has a really high duration. Mathematically, they're pretty close to the same bet. When interest rates rise, they both go down. So if your portfolio is 60% tech stocks and 40% long-term bonds, and that was pretty common 5-6 years ago, you don't have two asset classes. You really have one bet that interest rates are going to keep going down and the technology is going to do well. If rates stay high, you have a problem. In today's world, when the cost of money is 5%, gravity comes back, right? Companies that don't make profits can't survive, and bonds can't automatically save you every time that stocks fall. That means that the easy sort of diversification of just buying stocks, owning some bonds, is no longer the guaranteed shield that it was. So if that was kind of the old playbook, right? We used to talk about that in terms of like maybe 60-40, right? Might be a concept that you've heard, 60% in stocks, 40% in bonds. So what's the new playbook? And the first thing I would propose to you is that diversified portfolios are not dead, right? 60-40 as a concept is not dead, but we have to think about the diversifiers in a different way than we did in a very low interest rate environment. So we need to look for assets that have low correlation. We need assets that, the classic illustration, right, is we need assets that zig when the market zags, right? That means things like precious metals, commodities, specialized real estate that's not tied to the business cycle and interest rates. Gold is a great example of an asset here. Gold performs well when the economy is spiraling lower because investors are looking for some sort of stable store of value. It also performs well when the economy runs hot and inflation is higher than expected, because in that case, investors are looking for assets that appreciate as the dollar declines. So gold has a return profile that actually does well in either of those sort of tail events. We've been talking about that for a couple of years. So that's very different than the US stock market. It makes it a really good diversifying asset in a high interest rate environment. Think about other real assets like real estate, right? Some parts of the corporate office space are still struggling as more work kind of happens virtually, but there's lots of kinds of real estate, apartments, warehouses, farmland, industrial space, all kinds of things that can help diversify some of that S&P 500 and sort of the business cycle exposure that we see in portfolios. One word on real estate is very hot real estate right now is tied to data centers. If you go buy real estate that's tied to data centers, you're making, again, the same bet. US large cap tech, AI, all of that stuff, right? So we don't necessarily want to do that. So you have to think, even in some of these diversifying asset classes, you have to get really specific about what am I actually buying? What drives the economics of a particular investment? Even within your stock portfolio, markets outside the US tend to look very different than markets inside the US. Europe, Asia, they're less tech heavy. They're less tied to US interest rates and inflation. So other stock exposure can also help diversify your portfolio as well. And don't tell me, international markets haven't done anything for the last 10 years. These things tend to move in cycles. We have different regimes, right? In the 1980s, it was all international. In the 1990s, it was all the US. In the early 2000s, international again won. In the last decade, it's been all about the US. So when you have a real long-term lens, you can see that it's not always about the US all the time, and it helps to have broad equity market diversification. So you got to find assets that are not as correlated to stocks or, frankly, to sort of long-term bonds and interest rates. And then the second thing here in this sort of new world playbook is you got to rethink your bond portfolio. We're not just buying longer term bonds hoping for a capital gain. We've got to buy bonds that are going to produce income. The yield is real in the bond space now. We can find bonds from companies that are both in the US and around the world, in addition to debt from the US government, but also foreign governments, right? That have pretty good returns. Lower risk bonds are going to pay 3 or 4% a year, but you've got higher risk bonds that pay 7 to 9%. And a lot of times portfolio targets are kind of in the high single digit range. You can do that with some areas of the bond market today. So bonds can be a real source of returns in your portfolio now that interest rates are not at zero. So if you're combining bonds with, say, gold, some real assets, other types of things, now we've got a portfolio that's truly diversified and has the opportunity to do well if the market doesn't perform like we think it's going to perform. So by putting real diversification in your portfolio, you can still generate significant returns. This is really important. A lot of people think, oh, well, I'm going to earn all the money in stocks and then I have this other part of my portfolio. It's not going to do anything. That's not the case. You should think about this as just diversifying where the returns in your portfolio come from. You can get returns in other places besides the stock market. But by doing that, having a more diversified portfolio, you can also reduce the risk that any single global event or concern about a particular sector of the economy causes a significant drop in your portfolio. Owning lots of assets is not enough. So if you're just looking, again, we talked about this at the beginning, if you're just looking at the number of line items on your brokerage statement, that's not going to cut it. You've got to look at the correlation. You've got to look at what actually drives those assets to do well. A good test of that is if you sort of open up your account online and everything's green on the same day and red on the same day, that's a pretty good sign that you're not diversified, right? You're just leveraged, and that's what we want to avoid. So going back to my example from the beginning, if you're only selling sunscreen and ice cream, you're going to have a problem when it rains. So we want to think about adding assets that do well when the rain comes, and hopefully find some assets that will do well when the rain comes and also do a little bit well when the sun's shining as well. And there are lots of those kinds of assets out there, and that's what proper portfolio construction can help you find. So I hope you find this helpful as you think about building your own portfolio, as you look for something that both earns returns and is resilient over the long term. If you have questions, you can reach out anytime. I'm happy to have a discussion about your specific portfolio or your specific situation. And we'll talk to you next time on the next episode of the Capital Stewards Podcast.